Welcome to Just Some Guy Trading with 2021 World Champion Trader Kevin McCormick. Welcome back to Just Some Guy Trading. This is my weekly outlook for April 23rd. I have a ton of stuff to cover today, probably going to be one of the longest videos I've done. If you're a new viewer, know that the order of the video is going to go like this slide. We have a ton of stuff to cover on the stock market itself, so we're going to start with the S&P 500, NASDAQ, and Dow. Then we're going to hit the energy markets, crude oil, heating oil, natural gas, and we're going to finish up with the grains, soybean meal and soybean oil, wheat, and corn. As always, this presentation is for educational purposes only. All right, part of the reason why we have a lot to cover this week is last week's earnings were good, but it was a lot of smaller, mid-sized companies, and the market stayed flat. We'll get into the enormous short position by the hedge funds in a few minutes, but this is why this week and next week, I think, are filled for trading opportunities on both the indexes and individual stocks, because we're going to have the majority of the S&P 500 report over the next 2 weeks. But to highlight what's going on, everyone out there is negative, but of the 17% of the companies that have reported, 79% beat estimates, a 6% median estimate beat, 63% beat on the top line with a 4% median beat. This is not what the hedge funds and everyone in the media is telling you to expect this earnings season. It is supposed to have been a disaster. And this week is, I think, what's going to finally break the back of the hedge fund shorts out there. We have 178 companies reporting, including some of our mega cap companies that make up a large percentage of the S&P 500. We're going to start off Monday with First Republic Bank, which is going to be important because that's the one bank everybody is still worried about. But then this week, we're going to have Microsoft, Meta, and Amazon. These earnings are going to drive the market, and in my opinion, I think it's going to cause a short covering rally that's going to be very tradable for us. With that said, let's jump into the charts. Okay, this week I'm going to start off by taking a look at the commitments of traders report, because the hedge funds are unbelievably short right now. As you can see here, the blue line is the hedge funds, large speculators in the market, big money managers. You'll see here on March 17th, when we started to have the banking crisis, they started shorting heavily and have tripled their short position in a matter of a month. Their short position right now is at the lowest position it's been since October of 2011. Just taking a look here, you can tell when they get this short, it usually doesn't work well for them. This is classic groupthink, keeping on, adding to a losing position in the market. And right now, the hedge funds are all in on the market going down. Any kind of good news in earnings this week is going to cause a short covering rally. They even increased their short position by almost 15% this week. In my opinion, that's why the market stayed flat, because they refused to cover and kept their shorts on and added to them. They're in a very dangerous situation right now, and they're doing the same thing with the Dow Jones Index. As you can see here, very similar. Down here at a basically all-time low, you can see here as well, didn't work out well for them back then. Market rallied. It's an amazing possibility of just groupthink out there by the hedge funds. The only area where they're not short and have small positions right now is the NASDAQ, which is kind of ironic considering that we have major tech earnings coming out this week, and they make up a large portion of the S&P 500 and the NASDAQ index. But you'll see here, they've kind of removed their shorts from the NASDAQ market, but they're not at any kind of extreme reading. So what does this mean for this week and the coming week? Is I think you're going to have great trading opportunities for the next 2 weeks. I'm not sure that this rally is what's going to continue and stay, but it's definitely set up for a short covering rally. If we take a look at the S&P 500 right here, You can see we have our lows that were put in back here in December. We retested and we've gone higher. We've followed this trend line beautifully this week, and right now we're testing it along with the 18-day moving average. If we have a breakout up into these areas, which I think is very possible, it's going to be a very strong area of resistance. So if you're going long, like I will be this week, try and take advantage of this short covering rally. Make sure you're ready to take profits, because I'm not sure that this is going to be a long-term rally in the stock market. We have seasonals and cycles working against us that kick in about 2 weeks heading into May. And right now I'm leaning towards thinking we will have a pullback, but just not right now. I think there's going to be too many earnings out there that are going to be too good or not weak enough for the hedge funds to get the short they're looking for. They're going to be forced to cover, and this is going to cause a rally into the end of April, as I predicted before, a 3 to 4% rally in the month of April. With that said, let's take a look at the energy markets next. All right, we're going to start off by taking a look at the crude oil chart here. Back here was when we had the OPEC announcement, and if you were following me back at the beginning of April, I said it was very reasonable and we should expect that at some point crude oil will come back and fill this gap. Well, we're on the way there. My viewers also know I mentioned back during this time that we're probably going to be in a range between 65 and 85 in crude oil. The OPEC cuts announcements made me think maybe we'd get up to 90, but it's looking like 65 to 85 is going to hold in crude oil. Why do I feel that way? Well, you're going to see a trend on this week's video is Commitments to Trader report is full. It's just great information. And if you're wondering why we went from being up in this area and then starting down, all you have to do is look at what the producers of crude oil are doing. As soon as we got up in that 80 area, they started selling to the market. And who are they selling to? Hedge funds that are never going to use or take delivery of the oil. So hedge funds came in, OPEC news, started buying because they thought crude oil was going to go higher. And everybody that is actually producing crude oil sold those contracts to them, and continue to see producers of crude oil looking to lock in, I think, in the 80 to 85 area and filling this gap. As I mentioned, I think about a week ago, I said I'd probably look at more of a pairs trade. I'm not a big pairs trader myself, between heating oil and crude oil. Why do I feel that way? Well, it's a very different scenario for the heating oil contracts compared to crude oil right now. You'll see here, heating oil, while crude oil was being sold, they did not pick up their selling of heating oil. And in addition to that, we have a very strong seasonal pattern in heating oil right now, moving up and away. Sentiment is bad this week on heating oil on this pullback, and it is undervalued compared to gold and the US dollar. So I'm looking for buy signals in heating oil. I'm probably just going to let crude oil fall back some more and wait until it gets and sends me some good buy signals this week. You can see here that Williams percent R is in the buy area right now. I'm not thrilled that the trend of momentum has rolled over in heating oil, but as I said, I think this is just pressure from the complex itself when it comes to heating oil. So that's the area I'm looking for right now. I think we're going to continue to see the consolidation in crude oil. So next up, let's take a look at natural gas. Okay, with natural gas, let's start off by taking a look at the ADX indicator. As I've mentioned before, this is one of my favorite indicators for calculating when a bottom may be coming in. We got the false signal that it was going to shoot higher the second we crossed 40. Doesn't usually work that way. As I've highlighted everybody, we're looking for a clear breakout signal, and I think we are getting close to it. I know I've been saying that for weeks. But let's take a look at that Commitments to Trader report again. You'll see here we had commercial buying, hedge funds selling, huge increase in open interest over the last couple months. And here recently, the commercials have started buying once again of natural gas. Bullish sign. We're getting into the shoulder season when they may need to start refilling these supplies. Also, I've highlighted before, I avoid the Boyle leveraged ETF for at least one more week. We only have 5 days left on the front month contract. All the other contracts dated further back are selling at a premium of that front month contract, which is why I think it's possible that this week, but probably more likely next week, we're going to get a clear breakout sign that this trend is going to start moving higher. And I think we could get back up into the $3 area very quickly, but I'm looking for that confirmed breakout. We spent a couple days this week. This is very nice, good sign, above the 18-day moving average, just like we did back here with that false breakout that caught a few of us out there, where I said we need to see a complete trend break. But what I'd love to see this week, we saw it here, was to continue to make higher lows. We made a higher high, but if this holds, this will be a higher low. So it'd be nice if we could move up a little bit higher, and then one more pullback this week, and then we may get that confirmed breakout that I know many of us out there have been looking for in natural gas. But as I said, be careful with the Boyle ETF this week. There's still some contract rolling going on out there, and you can get burned in that leveraged ETF during contract rolls. That's it for the energy complex. Let's move on to the grains. Okay, let's start off by taking a look at soybean meal. As I mentioned last week, I was looking for a pullback into this trend line and taking buying opportunities from there. Got the pullback, but we did not get the rally I was looking for in soybean meal. I think soybean meal is still set up for a rally, but this week is the last week of the front month contract, so we might see the buying come back into the market after this week's contract roll. Soybean meal is still undervalued against gold and the US dollar. And then the other thing we have going on now is we've hit the seasonal low for soybean meal, and we expect it to rally into the future. But there's one thing I'm not thrilled about with soybean meal right now, and that's the commitments to trader report. Is the commercials have been selling soybean meal at these levels instead of buying, whereas where I'm going to be looking for buy signals this week, if we take a look at soybean oil, the commitments of trader report for soybean oil is very different. You can see here, we've had strong commercial buying into this decline for, the entire year so far. So I think this is the one that we want to take a look at right now is soybean oil. Not only do we have a good commitments of traders set up, we also have it undervalued as well. Good seasonals that we can take a look at here on the soybean. You'll see here that we are in the area where we should be rallying as well with the soybean oil. So for me, I'm going to be taking and looking for buy signals in soybean oil this week. And I'm going to take a closer look at soybean meal always during the week. But I think next week might be a better time for a rally. But, make your trade decisions out there based on what you're seeing on the charts. So let's jump into a few more charts. All right, now we're taking a look at the wheat chart with the ADX indicator. I've been looking for clear bottom signals here, and ADX, I thought we were going to get the cross above 40 this week, but this pullback, we had a rally and then a pullback, and ADX went down with it. We almost crossed 40 last week with the ADX. RSI is still coming down, so we may have another week or two here in wheat, but I think we're definitely forming a bottom in wheat. Commercials have been in here buying for a long period of time. Very heavy commercial buying in here. All it takes is one bad news coming out of the Black Sea exports for Ukraine, and wheat's going to shoot higher. And as well, you'll be able to see here, we've been forming this base at this area for well over a month now. We go back to the beginning of March when we first touched this area, and every time we come into this area, we have rallied off this area. Right now, we're in the Williams percent R oversold, so that's a buy signal at this area again. So I think it's probably a safe entry point as long as we don't make a new low to move higher in wheat. But I'm not sure if this is going to be a move for this week, but definitely something I'm keeping an eye on for the next couple of weeks is the wheat market. And the last thing I want to finish up on today is corn. All right, and we're going to finish up with the corn chart this week. If you watched last week's video, you know I highlighted the on-balance volume and the divergence that we were seeing as it was moving higher, but on-balance volume was moving lower last week. That gave me pause on my bullish positioning in corn. And sometimes it's nice to be right. We did move higher, but on-balance volume didn't move all the way up with it. We received a DeMarc sell signal right here on this day as well, and corn has now pulled back. Is this going to continue a pullback? I'm not sure. There's a lot of demand out there for the current corn crop, and this I think is just going to be a nice pullback and a move higher. You'll see here when it comes to Williams percent R, we're officially oversold, so we're in the area where we'd expect a bounce higher, and we're bounced perfectly on Friday right off the 18-day moving average, which is a good sign. So we're still continuing this trend up higher, very well-defined trend line higher. And I think this is something we'll probably be able to continue to ride, but we may still see some weakness this week in corn and really in the grains in general. We've seen some weakness over the last couple weeks, but the fundamentals are there for these markets to continue going higher into the summer. Thanks for watching Just Some Guy Trading. Don't forget to subscribe so you can find out when all my new content comes out. Thank you.